Okay, let's unpack this. Usually, when we sit down to do a deep dive on a corporate collapse, we are talking about a slow bleed. A company like Kodak or Blockbuster that just sort of missed the boat on innovation and faded away over a decade.
Right, the slow death by irrelevance. That is the standard narrative.
Exactly. But today, we are looking at something that is functionally the opposite of a slow death.
A supernova.
A supernova, that's a good way to put it. We are looking at a company that went from being the absolute titan of the industry, valued at $32 billion, plastering its name on NBA arenas, getting shout-outs from the biggest celebrities on Earth,
To nothing.
to literally zero. And not just zero, but a Chapter 11 bankruptcy filing and criminal charges in roughly a 3-year span.
It is arguably one of the most rapid and catastrophic corporate implosions in the history of financial markets. We are, of course, talking about FTX.
Of course.
And honestly, the speed of it is what makes it so terrifying. It wasn't a decline, it was an evaporation.
The crypto exchange, that was supposed to be the safe one. That was their whole pitch. The safe, easy way to get into crypto. SBF, Sam Bankman-Fried, was the golden boy. He was the adult in the room.
And that irony is exactly why this deep dive is so critical. We aren't just looking at some bad trades or a market downturn. We're looking at what the cleanup CEO, John J. Ray III,
The man who cleaned up Enron.
By the way, called a complete failure of corporate controls.
Which is a very polite, lawyerly way of saying it was an absolute disaster zone.
Yeah, to put it mildly.
When you actually dig into the source material, the bankruptcy filings, the court transcripts, it sounds less like a financial institution and more like a frat house.
I've heard that comparison a lot, and it's not far off.
I mean, we're talking about a group of friends, mostly in their 20s, living in a $30 million penthouse in the Bahamas, running a multi-billion-dollar empire using QuickBooks, and approving expenses with emojis on a chat app. It boggles the mind. It really challenges your perception of what a unicorn startup actually looks like on the inside. So our mission today is to really unpack how this happened.
We're going to trace the meteoric rise of Sam Bankman-Fried, or SBF, explore the specific technical mechanism of the fraud, because it is technical and we need to understand it, and look at the legal reckoning that followed.
And we've got a lot of ground to cover. We've got the Wikipedia records covering the history, the detailed breakdown of the 2022 crisis, and the legal fallout leading all the way up to the sentencing updates in late 2024.
There are some real aha moments in here. The secret back door in the code, the fatal flaw of their FTT token.
So buckle up. This isn't just a story about numbers. It's a story about hubris on a Greek tragedy scale.
And to understand the tragedy, we have to understand the origin, because the seeds of the destruction were planted right at the beginning. FTX wasn't the first act. It was actually the second act.
Right. This doesn't start in the Bahamas. It starts in Berkeley, California, back in 2017.
Correct. Sam Bankman-Fried, along with Caroline Ellison and others who had worked at the quantitative trading firm Jane Street, founded a company called Alameda Research.
I want to pause on Jane Street for a second.
Yeah.
For the listener who isn't deep in finance, this is a legitimate high-frequency trading firm, right? This isn't some fly-by-night operation.
Oh, extremely legitimate. It's one of the most prestigious and secretive firms in the world. They hire math geniuses from MIT to write algorithms that trade stocks and bonds in microseconds to capture tiny fractions of a penny in profit.
Okay.
That was the culture SBF came from. Smart, fast, algorithmic.
So he takes that smartest guy in the room energy and starts Alameda Research in Berkeley. And Alameda was a trading firm. They were the ones supposed to be making the smart bets on crypto prices.
Precisely. In the early days, they were doing arbitrage buying Bitcoin in one country where it was cheap and selling it in another, like Japan, where it was expensive. It was a money printing machine. They were very, very good at it.
But then, in May 2019, SBF and his co-founder, Gary Wang, decide that trading isn't enough. They want to own the casino. So they launch FTX.
And this is the crucial context for you, the listener. FTX was born out of Alameda. You have a trading firm, Alameda, and an exchange, FTX, owned by the same people.
And in traditional finance, like the stock market, that's usually a huge no-no, right? The New York Stock Exchange doesn't also run a hedge fund that trades against its own customers.
It's a massive conflict of interest, a cardinal sin. In regulated equity markets, there are strict firewalls. You cannot be the referee and a player in the game at the same time.
But in the crypto Wild West of 2019...
They just went for it.
Yeah.
They started in Berkeley, moved operations to Hong Kong for a while, and eventually in September 2021, settled in the Bahamas.
Why the Bahamas? Was it just for the weather and the lifestyle?
The lifestyle was a perk, I'm sure, But it was about regulatory arbitrage. The Bahamas had passed a new law, the Dairy Act, which created a framework for digital assets. It was, let's say, friendlier and less intrusive than dealing with the SEC in the United States.
Got it. So it allowed them to operate with a lot less oversight.
A lot less.
And I want to go back to that DNA of the company you mentioned. The source material says the dangerous DNA was there from the start because of this link between Alameda and FTX.
It was inextricably linked. Bloomberg reported later that Alameda functioned as the primary market maker for FTX early on. They provided the liquidity. If you wanted to buy Bitcoin on FTX, there was a very good chance you were buying it from Alameda's account.
Which sounds helpful on the surface. You need someone to sell to you until you realize that if the exchange is rigged to help the house's trading firm, regular users are sitting ducks.
They're just exit liquidity. But at the time, nobody seemed to care because the growth was absolutely explosive.
Meteoric is the only word for it. Let's just run through some of the investment numbers because they're wild. In August 2020, they acquired Blockfolio for $150 million.
Which was a huge deal at the time.
Then, in July 2021, they raised $900 million. That round valued the company at $18 billion.
$18 billion. In basically 2 years of operation.
That is insane speed.
And the investor list was a who's who of finance. SoftBank, Sequoia Capital, BlackRock, the Ontario Teachers Pension Plan. These are the titans of the industry. They weren't just throwing money at a kid. They were vying for the privilege of giving him money.
Sequoia famously wrote a fawning article about him, about how he was playing League of Legends during his pitch meeting, and they were just blown away.
They all wanted a piece of SBF.
And then just a few months later, in January 2022, they do it again. FTX Ventures raises another $400 million, and now the valuation is $32 billion.
To give you a sense of scale, a $32 billion valuation put them in the same league as some major established banks and massive tech giants.
Yeah.
And they had barely been around for 3 years. It was unprecedented.
There's also a really interesting detail in the notes about a rival, Binance.
Yes. Changpeng Zhao, or CZ, the CEO of Binance, he actually bought a 20% stake in FTX right at the beginning, about 6 months after it started.
Which feels like buying stock in your competitor before they get big. Like if Pepsi bought 20% of Coke when Coke was just a startup.
Exactly. It was a savvy move. But as FTX grew, SBF wanted that equity back. He didn't want his biggest rival having a seat at the table seeing his books.
He didn't want CZ owning a piece of his empire.
Not at all. So in 2021, he bought out CZ's stake for approximately $2 billion.
$2 billion to get your rival off your cap table. That transaction seems like a victory lap at the time. Look at me, I'm big enough to buy you out.
It must have felt that way.
But as we'll see later, that transaction actually loaded the gun that would eventually kill the company.
It did. It gave Binance the ammunition they needed later. But before we get to the fall, we have to look at the illusion of legitimacy. Because SBF wasn't just raising money, he was spending it to make sure everyone knew the name FTX.
Oh, the spending was everywhere. If you watch sports in 2021 or 2022, you could not avoid those 3 letters.
Not a chance.
They bought the naming rights to the Miami Heat's stadium. It became the FTX Arena.
Which is a classic move for a company trying to project stability. We have our name on a building. We aren't going anywhere. It anchors you in the physical world. Makes you feel real.
They had patches on Major League Baseball umpire uniforms.
I remember seeing that and thinking, the umpires, that's an interesting choice.
They sponsored the Mercedes-AMG Petronas Formula One team. Lewis Hamilton's car had FTX on it. They even sponsored TSM, the esports giant. It's a blitz.
And then there were the celebrities. Tom Brady, Gisele Bündchen, Stephen Curry, Shaquille O'Neal, even Kevin O'Leary from Shark Tank, Mr. Wonderful himself, was a paid spokesperson.
It's wild to think about now. Tom Brady and Gisele were actually equity holders. They lost millions.
They did.
And there's that one anecdote that stands out to me, the one deal that didn't happen.
Ah, yes.
Taylor Swift.
Yes. They were in talks for a $100 million sponsorship deal with her. Can you imagine the Eras Tour, brought to you by FTX? It reportedly broke off in the spring of 2022. In hindsight, that was the luckiest break of her career. But the point of all this spending wasn't just vanity. It was to build a moat of trust.
That's a good way to put it.
If Tom Brady uses it, if it's on the NBA arena, if the MLB umpires wear the logo, the subconscious message to you, the regular person, is, this is legit, This is regulated. This is safe.
Right. It masked the reality. Because while the outside world saw glossy ads and Super Bowl commercials with Larry David—
Which was a great commercial, by the way.
Hilarious. But while they saw that, the inside was—
Well, let's get into the mechanism of the fraud, because this is where you really need to understand the nuts and bolts. How did this machine actually work?
Okay, so at its core, it was about the relationship between FTX and Alameda Research. On paper, they were separate entities. SBF claimed Alameda was just another user on the platform, subject to the same rules as you or me.
But we know now that wasn't true. Not even close.
Far from it. John J. Ray III later revealed that Alameda had a secret exemption from FTX's auto-liquidation protocol. Okay, auto-liquidation protocol. That sounds incredibly technical, but it's actually the bedrock of how a crypto exchange survives. We need to break that down for the listener.
Let's do it. So imagine you are trading on an exchange. You want to make a big bet, so you use leverage. You borrow money from the exchange. Let's say you put down $10 of your own money to bet $100.
Okay, so if the price goes up, I win big. But if the price drops—
If the price drops by just 10%, your $10 of collateral is gone. You are now at zero. In a normal system, a safe system, the risk engine kicks in immediately.
Right.
It automatically sells your assets to cover the loan before you lose more than you have. It liquidates you.
It's like a bouncer at a club. If you run out of money for drinks, you get thrown out immediately. The bar doesn't let you run up a tab you can't pay.
Exactly. It protects the exchange,
Yeah.
and, crucially, it protects the other customers. But Alameda had a secret switch in the code.
A switch in the code.
Literally a piece of code that said, allow negative, that exempted them from this protocol. Gary Wang, the co-founder, testified about this in court.
So if I'm Alameda and my bet goes down 10%, nothing happens.
Nothing happens. Your account just goes negative.
It goes down 50%.
The system ignores it.
So they had an infinite line of credit.
Effectively, yes. They could keep losing money, and the system wouldn't stop them. And here is the scary part. Since they were losing money and the exchange wasn't stopping them, who was covering those losses?
It has to come from somewhere. It can't just be imaginary money.
It came from the customers. FTX lent approximately $10 billion of customer assets to Alameda to plug these holes.
$10 billion. That is money that people thought was sitting in their accounts. Safe and easy, right? That's just— it's theft, isn't it? Legally, what is that?
It's misappropriation on a massive scale, commingling of funds. It's one of the oldest sins in finance. Alameda was using that customer money to make risky venture capital bets, buy real estate in the Bahamas, and make massive political donations.
But there is another layer to this scheme, and that is the FTT token.
Right.
The FTT token. This is the flywheel effect people talk about. What exactly was FTT?
FTT was a cryptocurrency token created by FTX itself. On the surface, it gave you discounts on trading fees and things like that.
Yeah.
Standard loyalty point stuff.
Airline miles for a crypto exchange?
Good comparison. But Alameda held a massive amount of it. The company just printed these tokens and gave a huge chunk to its sister company.
Okay, so the company prints its own money, essentially.
Yes. And here's the trick. The trading volume of FTT was actually quite low, was illiquid. But because the price in the exchange was high, Alameda could list these tokens on their balance sheet at that high price.
Let me see if I have the analogy right. It's like I print 1 billion tokens in my basement. I sell one to you for $10, and now I turn around and tell the bank, look, I have 1 billion tokens worth $10 each. My company is worth $10 billion. Lend me real money against it.
That is exactly the analogy. It's mark-to-market accounting gone horribly wrong. It's like printing monopoly money, valuing it at a high price based on very few transactions, and then, this is the critical part, using that monopoly money as collateral to borrow real money.
And they were borrowing the real money from
FTX customer deposits.
So it's a completely closed loop.
A circular dependency. As long as the price of FTT stayed high, the illusion held. Alameda looked solvent because it had billions in FTT assets. FTX looked solvent because it had a huge loan receivable from Alameda that was backed by this FTT.
But if the price of FTT crashed,
the collateral becomes worthless, the loans go bad, the customer money is gone, the whole house of cards collapses.
And that brings us to November 2022, the catalyst. Because for a long time, nobody knew this was happening. It was just a black box. What cracked it open?
It was a report by CoinDesk on November 2, 2022. CoinDesk is a crypto news outlet. They got their hands on a leaked balance sheet from Alameda Research.
A leak. And what did they find in this document?
They found that the emperor had no clothes. The report showed that a huge portion of Alameda's assets were just FTT tokens. Specifically, they had $3.6 $6 billion in unlocked FTT and another $2.16 billion in FTT collateral.
So the hedge fund that was supposed to be a master of the universe, doing high-frequency arbitrage, was basically just holding a giant bag of tokens printed by its sister company.
Exactly. It revealed the insolvency. It showed that if FTT dropped in price, Alameda was functionally dead. But the market didn't panic immediately. It took a few days for the info to digest. The spark that really lit the fire came 4 days later, on November 6th.
Enter CZ from Binance again?
The rivalry returns. Remember, Binance had received a bunch of FTT tokens when they sold their stake back to SBF.
Right, the $2 billion buyback. A lot of that was paid in FTT tokens.
On November 6th, CZ tweeted that, due to recent revelations, a clear reference to the CoinDesk report, Binance would be selling all of its remaining FTT holdings.
Oof. That is a vote of no confidence if I've ever seen one. And he didn't do it quietly. He announced it to the world on Twitter.
It was a declaration of war. And because the market for FTT was so thin, remember it was illiquid, everyone knew that if a whale like Binance started selling, the price would crater. There weren't enough buyers.
So it's a race to the exit everyone else tried to sell first.
Exactly. It triggered a bank run.
Yeah.
But not just on the token on the exchange itself. The story made people nervous about FTX's health. Customers rushed to withdraw their real money, their Bitcoin, their dollars. We saw an estimated $6 billion in withdrawals in just 72 hours.
$6 billion. Imagine the scene inside FTX. SBF is scrambling. He's tweeting, assets are fine, trying to calm people down. He's deleting tweets. But the money simply wasn't there to pay people out, was it?
No, because it had been lent to Alameda, and Alameda had lost it or tied it up in illiquid venture bets in Bahamian real estate. The liquidity crunch was immediate and total.
And then came the weirdest plot twist of all. For a brief moment, it looked like Binance was going to save them.
It was whiplash. On November 8, CZ announced they had signed a non-binding letter of intent to acquire FTX. He basically said, we'll step in and cover the liquidity crisis to protect users.
I remember seeing those headlines. Binance buys FTX. SBF probably thought he was saved. He thought he could sweep this whole mess under the rug.
But notice the phrase non-binding. Binance started their due diligence looking at the books, and it took them less than 24 hours to run for the hills.
Less than a day. What did they say?
On November 9, they walked away. They issued a statement citing mishandled customer funds and pending U.S. agency investigations. It was essentially a polite way of saying, this is a crime scene and we are not touching it with a 10-foot pole.
That must have been the moment the reality set in for SBF and his whole team.
It was. SBF had to admit to his employees on Slack that Binance bailed. The company officially stopped processing withdrawals. And on November 11, 2022, the inevitable happens.
Actually, 11.
FTX, FTX US, Alameda, and over 100 affiliated companies filed for bankruptcy protection in Delaware. SBF resigned as CEO.
And this is where we meet the new sheriff in town, John J. Ray III.
A legendary figure in the world of corporate restructuring. As we mentioned, he was the man who cleaned up Enron. He is the guy you call when the building has not only burned down, but the ashes are radioactive.
And you'd think if you cleaned up Enron, you've seen it all. But his comments about FTX were just scathing.
He didn't mince words. He stated in a court filing, and I'm quoting here, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information."
Complete absence. Coming from the guy who handled Enron, that is terrifying.
He testified to Congress that there was literally no record keeping, no list of bank accounts, no list of employees. He noted that this multi-billion-dollar conglomerate used QuickBooks software designed for small businesses, for local bakeries, for its accounting.
And I love the detail about how they approved expenses. It wasn't through a formal audit process with a CFO signing off.
No, it was often just emojis in a chat app. If an employee wanted millions of dollars for a sponsorship or an investment, they would put it in the chat, someone like SBF would put a thumbs up emoji, and the money moved.
It sounds like a fraternity house managing a hedge fund.
That is not a terrible description. Ray also noted that they used software to conceal the misuse of customer funds. This wasn't just incompetence, it was, in his view, deliberate obfuscation.
Now, right when the bankruptcy hits, late at night on November 11th, things get even crazier. There's a hack.
Yes, as if things weren't chaotic enough. Late on a Friday night, Over $473 million was siphoned out of FTX wallets.
I remember this vividly. Twitter was melting down. Everyone thought it was an insider. They thought, oh, SBF or one of his lieutenants is running off with the last of the cash before the liquidators get it.
It was the logical assumption. Ryan Miller, the new general counsel, called them unauthorized transactions, and they had to move the remaining funds to cold storage offline wallets just to stop the bleeding. It was panic mode.
But it turned out, years later, that it wasn't an insider after all.
That's right. It wasn't until January 2024 that the mystery was solved. The Department of Justice indicted 3 individuals for a SIM swap scam.
Okay, explain that quickly for the listener. What is a SIM swap?
SIM swapping is a surprisingly low-tech technique where a hacker tricks a cell phone carrier like AT&T or Verizon into transferring your phone number to their device, their SIM card.
Oh, wow.
Once they have your number, they can intercept all your calls and, more importantly, the text message codes used for two-factor authentication.
So these massive crypto wallets holding nearly $500 million were protected by little more than a phone number.
Essentially, yes. Inadequate security protocols. These hackers saw the chaos, pounced, and managed to steal around $400 million, which was later confirmed to be the FTX funds. It adds another layer of absurdity, that even while the house was burning down from the inside, looters were breaking in through the windows because the locks were cheap.
The collapse of FTX wasn't isolated, though. It was like a bomb going off in the center of the crypto industry. The contagion was real.
Absolutely. You have to remember how interconnected these firms were. BlockFi, a major crypto lender, had significant exposure to FTX. They had lent them money, they had assets on the exchange, they halted withdrawals and prepped for bankruptcy almost immediately.
Genesis, another big lender, halted withdrawals too.
And Solana. We have to mention Solana. It was a blockchain heavily associated with and supported by SBF and Alameda. Its price plummeted because people feared the FTX bankruptcy estate would have to dump their massive holdings of the SOL token.
And what about those institutional investors we mentioned earlier? A Smart Money, Sequoia, Temasek, the Ontario Teachers Pension Plan.
They had to write their investments down to zero. Sequoia lost around $214 million. They released a public statement basically apologizing to their limited partners, saying they were misled.
That's a huge black eye for a top-tier venture capital firm.
It shattered the idea that smart money always does its due diligence. They got duped by the story and the hype, just like the retail investors.
So the company is dead, the money is gone, or so it seems at the time. Now comes the legal reckoning. SBF is in the Bahamas. What happens next?
The wheels of justice turn surprisingly fast. Usually, white-collar investigations take years. But the evidence here was so overwhelming, and the cooperators flipped so fast. On December 12, 2022, just a month after the bankruptcy, SBF was arrested in the Bahamas at the request of the U.S. government.
And he was extradited to the U.S. pretty quickly.
He was. He was flown to New York and charged with a slate of federal crimes. Fraud, conspiracy to commit money laundering, and campaign finance violations.
His plea.
He pled not guilty and was released on a massive $250 million bond to house arrest at his parents' home in Palo Alto.
Which became a media circus in itself. But while SBF was pleading not guilty and starting a Substack to defend himself, his inner circle was singing a very different tune.
This is key. The code of silence did not hold for a second. Gary Wang, the co-founder, Caroline Ellison, the CEO of Alameda, and Nishad Singh, the engineering director, they all flipped.
They recognized the prisoner's dilemma immediately. The first one to talk gets the best deal.
They did. They pled guilty and agreed to cooperate fully with the prosecution. And their testimony during SBF trial was absolutely damning.
Specifically, Caroline Ellison, she was the star witness, wasn't she?
She was. She had kept diaries. She had Google Docs. She testified that SBF directed her to commit these crimes. She confirmed that he knew about the borrowing of customer funds, that he directed the specialized code changes, and that he had her prepare false balance sheets to show to lenders.
It just completely destroyed his defense that this was all just a mistake or bad management.
Completely. And so let's fast forward to the sentencing, because we have updates from 2024 that really close the loop on this. SBF, of course, was found guilty on all 7 counts, and in March 2024, sentenced to 25 years in federal prison.
25 years. A significant sentence.
Very. But let's talk about the others. What happened to the cooperators?
Yeah, let's look at the outcomes. First up, Ryan Salame. He was another high-ranking executive, though not in the inner circle like Caroline or Gary.
Ryan Salame pled guilty to campaign finance violations and operating an unlicensed money-transmitting business. He didn't cooperate to the same extent as the inner three. In May 2024, he was sentenced to 7.5 years in prison.
7.5 years. That's still like significant time. Now, compare that to Caroline Ellison. She ran the hedge fund. She was at the center of it.
She was sentenced in September 2024. Judge Lewis Kaplan gave her 2 years in prison.
2 years for a multi-billion-dollar fraud? That feels light.
It is light, historically speaking, but Judge Kaplan explicitly noted her cooperation. He said it was substantial and came at great personal cost. But he also said it wasn't a get-out-of-jail-free card. He had to balance the severity of the crime with sending a message that cooperation pays off for future cases.
I see. And then Nishad Singh and Gary Wang, the tech guys.
Nishad Singh, sentenced in October 2024. Time served plus 3 years of supervised release. Gary Wang, sentenced in November 2024. Time served plus 3 years supervised release.
So they walked free, essentially. No additional prison time.
Correct, because their testimony was the nail in the coffin for Bankman-Fried. Gary Wang, for instance, was the one who could walk the jury through the actual code, the allow negative flag. Without him, proving the technical mechanism of the fraud would have been much harder. The judge viewed their roles as more limited and their help as essential to the conviction.
It really shows how the system works. If you talk first and you talk most, you save yourself.
That's the incentive structure.
Yeah.
But there's one final surprising twist in this story. The customers.
Right. Usually in these crypto collapses, like Mt. Gox back in the day or Quadriga, people lose everything. Maybe they get pennies on the dollar years later if they're lucky. What happened with FTX?
In a bizarre turn of events, the bankruptcy estate under John Ray III managed to recover a massive amount of assets. They clawed back donations, they sold off venture investments. In August 2024, a U.S. court ordered FTX to pay $12.7 billion in compensation.
Wait, does that mean customers are getting all their money back? That seems impossible.
Yes. And no. This is the catch, and it's a painful one for many victims. The bankruptcy plan approved in October 2024 pays customers 100% of their claim value plus interest.
That sounds great. Why is there a catch?
Because the claim value was fixed in U.S. dollars at the time of the collapse, November 2022.
Ah. And the crypto market was in the toilet in November 2022. It was the absolute bottom of the bear market.
Exactly.
Yeah.
Bitcoin was trading around, what, $16,000 or $17,000 then? By late 2024, Bitcoin was trading vastly higher, over $60,000 at times. So if you had one Bitcoin on FTX, you aren't getting one Bitcoin back. You are getting $16,000 back.
Right.
Oh, that hurts. So you miss out on the entire recovery of the market. You get your dollar value back, but you lost all of the potential asset appreciation.
You do. It's a huge point of contention for creditors. But in the world of bankruptcy law, getting 100% of the dollar value of your claim is almost unheard of. It's a miracle. Usually creditors get 10 cents on the dollar. So it's a success legally. But it feels like a loss financially for the victims who were long-term believers in crypto.
It's fascinating that the assets they recovered, like the stake in the AI company Anthropic and other venture bets, actually held their value or grew.
Right. And SBF often claimed during his trial that if they just let him wait it out, he could have made everyone whole. He argued there was a liquidity crisis, not a solvency crisis.
But does that argument hold water?
Not really.
Yeah.
The successful bankruptcy recovery sort of proves that the assets were valuable, yes, but it doesn't excuse the fraud of using customer money without permission to buy them in the first place.
Right. It's like the Robin Hood defense. But he was robbing his customers to pay for risky bets that happened to pay off for the bankruptcy estate years later.
Precisely. You don't get credit for winning at the casino if you stole the chips to play.
Yeah.
And remember, the reason the assets were recovered is because John Ray III and his team spent 2 years hunting them down and liquidating them in an orderly fashion. Not because SBF was some genius portfolio manager who just needed more time.
So when we step back from all this, what does it all mean? We've watched this empire rise, we've dissected the technical fraud, and we've seen the legal conclusion. What is the big takeaway here?
For me, it highlights a massive contradiction in the crypto industry. This entire technology was built on the premise of decentralization. The ethos is don't trust banks, trust code. Verify, don't trust.
And yet, millions of people handed their money to a centralized entity run by a guy who slept on a beanbag chair.
It was the cult of personality. Investors, media, and customers overlooked glaring red flags because of the image SBF cultivated. The effective altruism, the messy hair, the Toyota Corolla. It was a costume of humility masking extreme greed and arrogance.
It really was. And the ultimate irony is that this future of finance company failed because of the most old-school reasons possible. Bad bookkeeping and embezzlement. It wasn't a blockchain failure. It was a QuickBooks failure.
It proves that human intermediaries are always the weak link. Whether it's a bank in 1929 or a crypto exchange in 2022, if you give someone custody of your assets without absolute transparency and robust controls, you are at risk.
It definitely makes you look at the trustless promise of crypto differently. Maybe the technology works, but the bridges we built to it, the exchanges, are still incredibly shaky.
It raises a provocative question for you, the listener, to leave with. The legal system worked eventually. SBF is in jail. The bankruptcy process worked eventually. People got their cash back, more or less. But does the FTX saga prove that we need more heavy-handed traditional regulation to protect people? Or does it prove that the crypto industry needs to stop trying to replicate banks and actually build systems where custody never leaves the user's hands in the first place?
That is the billion-dollar question. Because as long as there is a middleman, there is a risk that the middleman is using emojis to gamble with your savings.
A sobering thought to end on.
Indeed. Well, that's our deep dive on the rise and fall of FTX, from the penthouse in the Bahamas to a federal prison cell. Thanks for listening, and stay curious.